Hi, welcome to our monthly webinar. If you can hear me loud and clear, okay, your top right hand corner, there's a chat box. You click on the chat box and you type yes, so that I can know that you can hear me loud and clear, okay? Okay, thank you, Alvin. Thank you, Jacob. Thank you, Cecilia, and thank you, David. Okay, I believe all of you can hear me loud and clear. Firstly, I'd like to apologize for last week webinar. Okay, there's some technical issue, and today you can see that our system is a different system. So we totally switched a new system. I hope that this issue will not be happening again. So once again, welcome back for how on the topic today on how do you invest with your CPF money. So right now, I'm going to share my screen with you, and I'm going to talk about the CPF. Give me a minute. I off my webcam first. I'm going to share my screen. Okay, I believe now you can see my slides. Okay. Okay, so welcome back. Okay, so today our topic is about how to invest your CPF money. So I'm going to share the usual disclaimer. Whatever I'm speaking today is not a recommendation of buy or sell. It's for educational purpose. Okay, so most of us knows that our ordinary account, which is the OA account, makes 2.5%, and our special account, which is the SA account, makes 4%. But if you go to Google about CPF investing, you'll come out this article. Okay, so what this article says that they did a study on all those people who took the CPF money, right, to invest, and they realized that only 15% of the total CPF member, right, managed to make returns more than 2.5%. That means only 15% make returns more than the OA account. Okay, and 40% of them, right, actually make losses while investing through their CPF. Okay, so what can you do, to ensure that you are in the 15% category instead of the other 40% category? So in my latest slide, I will tell you what type of companies and when is the best time to invest, so that you increase your probability of being in the 15% category. So now let me move on to talk a bit about the basic of investing in CPF. So before you can invest in CPF, right, you have to be eligible to invest. So they have three criteria that you must fulfill before you can be eligible. The first criteria is you must be at least 18 years old. Okay, so if you're not 18 years old, you cannot invest. So that's the minimum age that you have. Next, you must not be declared bankrupt. So if you've been declared bankrupt, you cannot use your CPF to invest. And lastly, you must have at least $20,000 in your OA account, okay, which is your ordinary account. So on top of that, whatever excess, right, you then can invest. Okay, so let us move on to calculate what's the amount you can invest after you hit the minimum 20,000. So how much can you invest using your CPF? So basically CPF, they have two methods to calculate. Okay, the first method, which is method A. Okay, so for example, your OA account, you have, let's say, 50,000 inside your OA account. Okay, so your OA account got 50,000. Then what they do is they will take 35% of the 50,000. So 35% of the 50,000 is 17,500. So this 17,500 is the amount you can invest. Then the CPF will do another method, which is the method B, which is your OA still have 50,000, but your first 20,000, right, you cannot invest. So they'll take your 50,000 minus off your 20,000, which give you 30,000. So 30,000 is the amount that you can invest using your CPF. Okay, so now you got these two numbers, 17,500 and 30,000. So which one do CPF will choose? Okay, usually CPF will take the lowest of the two number. So which is you only can invest 17,500. Okay, CPF, they want to play safe, so they give you the lower number to invest. Okay, but if you are too lazy to calculate yourself, right, the amount that you can invest, right, don't worry. Okay, you can basically log on to CPF, okay, the website, using your SingPass. They already calculate for you. So basically, once you log into your CPF account, right, you select my statement. So under my statement, right, there's this section called section C. So under section C, right, there's this thing called stock. So once you look at the stock, they'll tell you the amount you can invest in stocks using that amount. Okay. So once you know that you can use the money to invest, the next thing you want to know is how to open a CPF investment account with the local bank to invest. So in the CPF only approved 3 local banks in Singapore that can use your CPF money to invest. So it's OCBC, UOB, and DBS. Okay, so these are the only 3 approved banks. So you need to open CPF investment account with either one of these 3. Okay, so that you can buy and sell shares. So one thing you need to take note is that you don't need a bank account with either of these banks, right, to open a CPF investment account. So for instance, personally, I open in UOB, okay, but I do not have a UOB bank account. So, but I still can use a CPF investment account with UOB. So don't worry about that, okay. It's very, very simple to open this account. You just need to approach the counter and tell them, say that, okay, I want to open a CPF investment account. So probably they will tell you the procedure and the form you must fill up. So once you fill up, it takes you probably a few days or maybe 1 or 2 weeks for the account to open. So once the account open, they will send you a letter. Okay, at the letter, they got this, your CPF investment account number. Okay, once you got that number, right, you need to take this number, right, and go to your broker. Okay, and tell a broker, okay, this is my CPF investment account number. Please link up with your broker. Okay, so for instance, my broker is CIMB. I take my UOB CPF investment account number. I go to my CIMB broker. I tell him, okay, please link up with my CIMB brokerage account. So next time, if I want to invest in the market, right, I just need to call my broker. So let's say I call my broker, maybe John. So I say, John, help me buy, for instance, Vicom. Okay, this company Vicom, using my CPF money. Okay, then he will do it for you. He'll transact for you. Okay, so now you know the 3 banks that you can open your CPF investment account. The next thing is you want to know the charges that each of them provide. So these tables, right, shows you the charges that 3 of the banks actually provides. So if you can look at all of them, right, they are rather similar in charges. The only thing different, right, is the buying and selling of each shares. UOB is the cheapest, you can see from there, $2 per 1,000 shares. Whereas OCBC and DBS, $2.50 per 1,000 shares. So, like I said, UOB is the cheapest. So that's the reason why, I use UOB as my CPF investment account. Because, I believe that every dollar you save, right, is every dollar you earn. So one thing I want you to take note is that once you sell a stock, let's say you sell a stock through your CPF account, okay, and you need to call the bank, right? Let's say I use UOB, so I need to call UOB and say that please transfer my money from the bank, the CPF investment account, to my CPF. Okay, but if you don't do that, after 2 months, they'll automatically transfer it for you to back into your CPF. So if you want the money to faster go back to CPF, you call them up. If you don't want, you just wait for 2 months, they'll transfer it for you. Okay, just take note, this is only the charges from the bank. When you buy and sell shares from using the broker, right, the broker also will give you charges. So that's why in order to invest in CPF, you have to keep your cost very low. So for me, I always take the lowest cost one. Okay. So next is once your account all approved already, right, you only can invest your money in CPF approved shares. Okay. And the thing that I want to really, really emphasize, a lot of people, right, they come to me and say, Victor, I can buy any of the CPF approved share because they are approved by CPF. So that means they must be good company. Okay. Please, CPF approved shares, right, does not mean they are safe to invest, and it does not mean they are good companies. They just need to fulfill, right, these 5 criteria. And I show you what is the criteria. First, the company must be incorporated in Singapore. Second, the company are listed on the SGX main board as primary listing or former SESDAQ shares. Okay, and the company share must be traded in Singapore dollar. Next, the agent banks are being allowed by the company to appoint all CPF shareholder of the company as proxy to attend or vote at the meeting. And lastly, the company must not be in the SGX watch list. So looking at all these 5 criteria, none of these criteria tells you that, any of these companies are good, fundamental, strong companies, are companies that are very safe to invest. Okay, so remember, CPF approved shares doesn't mean that they are safe to invest. Okay, always you have to do your analysis. So out of the total shares that SGX has about 1,004. Okay, out of this 1,004, right, there's 4,444 CPF approved shares. Okay, so that means about 44.2% of the total population of the SGX company actually are CPF approved. So now let me show you, okay, where can you find for CPF approved share. Okay, so now I'm going to stop the screen sharing. Okay, I'm going to show my face again, and I'm going to show you, the website. So basically you go to SGX. Okay, so can you see the SGX now? Okay, so you have SGX, you go to company information. Okay, then you go to can you see a screen? Okay, give me a minute. Okay, I think some of you face some technical issue, is it? Okay, give me a minute. Give me a minute. Okay, so now I'm going to teach you where can you find the CPF approved share. Okay, basically you go to sgx.com. Okay, you go to stock and indices list. You click on it. You can see view all CPF investment scheme. Okay, so all these companies you can see CPFIS. Yes. So all these are the approved shares. So there's 444 of them that is approved. Okay, so now let me move on to the slides. Okay, so now you know where can you find the CPF approved share. Next is the type of companies that you want to you want to invest using your CPF money. Okay, so there's certain criteria I have for my using my CPF money to invest. Firstly, I avoid using my CPF money, right, to buy into REITs, okay, real estate investment trust. Why? Because for REITs to grow their portfolio or grow their rental to give more distribution yield to back to the shareholder, most of the time they have to raise rights issue. Okay, so if you invest using your CPF money, let's say, and the risk so happens to call for a rights issue, you need to fork out money if you don't have enough money in your CPF. You must remember your CPF amount, even though you got a large sum, right, there's always a limit cap to buying a stocks. Okay, so if you are not in the limit, you have to top up using your own cash. So don't invest REITs using your CPF. This is the first thing. Second, don't invest in cyclical or project-based business. So all these companies, right, are cyclical in nature. Their revenues go up and down, their profit ups and down. They go in cycles. Okay, only use your CPF to invest in more predictable business. Okay, so avoid all these cyclical business. Okay, look for dividend paying companies. That's the one thing that you need to do it. Okay, next, the company must be predictable in nature. Okay, so which is recurring, the products people always use one. So it's recurring, predictable, very stable revenue, very stable profit, up and down, but don't fluctuate a lot. That's one thing that you need to take note. And lastly, the company must have very strong balance sheet. Okay, so I want to buy into companies that have more cash than debt instead of more debt than cash. Okay, if the company have more debt than cash, they may face into some financial issue in the probably the near future. Okay, so take note about that. Okay, and like I said, our risk-free rate for the CPF is about 4%. That's your SA account, your special account, which is confirmed 4%. So if you want to invest in a using your CPF money, must always make sure that you can invest, right? You can make more money than 4%. That means you can invest in a company that give you a dividend yield, right? More than 4%. Preferred like double the percentage, which is 8% or more. So that is your target every time when you look for companies to invest. So when is the best time to invest, right? Is to invest during crisis. Okay. So you can see that, throughout the years, there's always crisis all around always throughout the years, you always experience crisis. And this is a best time where stocks are very, very cheap and your downside risk is very limited. Good companies also selling at a very cheap price. And your probability of making money, not only by getting a high dividend, but also getting a very, very good capital gain. Okay. So later I'll show you an example of that. So remember, always buy during the crisis, because you must know CPF is your hard-earned money. Okay, you have to buy it when it's the most safest. You don't buy it anytime you like it. Okay, so avoid that. Okay, so if you look at the past 20 years, right, from 2017, right, we have experienced 6 crises: the Asian financial crisis, the dot-com crisis, the SARS crisis. You also experienced the 0809 crisis, the Euro debt crisis, and recently the China stock market crash. All these crises, right, the share price dropped more than, the index dropped more than 20%. So all these are opportunity for you to deploy your CPF money. So if you take 20 divided by 6 crises, right, almost every 3 years you got a crisis. Okay, that drops more than 20%. So it gives you an ample of opportunity to invest. So do not be very, very eager to invest your money, because I can tell you a lot of people make mistakes because they are very eager to invest their money. They said, oh, Victor, I have this large sum of money. I want to invest right now. And the market now is so expensive. And you want to invest right now, okay, you are just increasing your chance of losing money. Remember, when it comes to investing, it's all about protecting your downside. Okay. So next, let me show you an example of case study. So for instance, let's say this company called Singapore Airport Terminal, which is SATS, okay? And you want to invest SATS, let's say during the 0809 over here, okay? But of course, you cannot buy at the bottom. So let's say assume that from the peak, the company dropped by half. So let's say you buy at $1.38. So what happened? Let's say you saw the price $1.38. So you want to screen SATS and see that whether they pass our criteria. Okay, so now I'm going to the download the SATS annual report, and I'll go through to you at the point of time what happened and what you should see. Okay, so let us go to the SATS during the 0809 time. Okay, so let me goes to my here. So just type, you want to find the annual report, just type SATS investor relation. Okay, so you have SATS investor relation. Okay, so you can see under investor relation, there's this thing called financial reporting. Okay, click on it. So I click on annual report. Okay, give me a minute. Okay, so I go to archive. So I go to at the point of time when the crisis happened. So it's the 0708, okay, time. So let the annual report load. Okay, so if you go to the annual report, okay, let me go to the financial highlight. Okay, to do the screening. Okay, so the financial highlights is here. Okay, so next is now let us go back to our the criteria that we talk about. Okay, the 5 criteria. So avoid investing in REITs. So SATS is definitely not a REITs. This first thing. Second, avoid investing in cyclical and project based company. Okay, only invest in predictable company. So if you think about SATS, right, what type of business is SATS in? So SATS is in the in-flight catering business. So they basically you in Singapore airport, right? Any planes that come in, right? They'll provide the food to the plane. Okay, and these are recurring in nature. Okay, if you look at SATS, it's 80% of the total Changi Airport market share is owned by them. So basically, they are market leader, very stable. Business is recurring in nature. Okay, so this is what, so it passed all that few criteria. So next, you want to look at their revenue, whether they are stable. So if you look at their revenue at this part, you can see their revenue. So it's 800 million, 900 plus, 900 plus, 900 plus, 900 plus. So rather stable. They don't fluctuate up and down. They don't go 900 to 500 to maybe 300, then suddenly go up back to 1 billion. It's not like that. Okay, very stable. You look at their profits, same thing. Every year making the same amount, 180 something, 160 something, 180, 17, 19. The fluctuation is not a lot. So it's very, very stable. Next, let us look at, let's say their debt level. You don't want them to be heavily geared. So if you look at their total debt, okay, it's only 0.15, 0.15, 0.21, 0.23. So nothing much. Their debt level is very, very low. And if you look at the dividend, consistently giving dividends, interim and proposed here, you can see from here. So every year that you can get a minimum of maybe 10 cents, okay, all the way to 14-cent dividends. So that is one thing, look at SATS. Next thing I see whether is the company having a strong balance sheet. So let us go to the balance sheet segment. So you want them to be in a net cash position. So let me scroll down. Okay, well, the page is still far away. Okay, I'm here. Okay, let's look at their balance sheet. So if you look at their balance sheet, okay, let us find their cash. So basically, their cash is this fixed deposit and cash balance. So you can see that they got about, probably if I add out, roughly about 600 million. Okay, if you look at their debt is only this term loan or probably this finance lease. So actually, they've got very, very small amount of debt. So not much of a debt. So you can see that mostly they are in net cash position. So this company pass our criteria. Okay, so now let me go back to the slides. Okay, let me share. Okay, so let's say you bought SATS at 138 because it passed all your criteria. Okay, so at that point of time you bought in 2009, you'll get a dividend yield of 7.2%. Okay, definitely more than your 4% in your special account. Okay, so that's the thing. We want to get more than, or if better, we want to get double the percentage. Okay, but if you keep moving on, okay, so 2010 they increased their dividend 9.4%, 8%. You see, it beats your all your SA your special accounts percentage. This is based on the dividend given based on this share price that you bought 8%. 8%, you see? Now can you see that your dividend is keep increasing based on your purchase price? Okay, so at 2016, based on this $1.38, you're getting close to 11% dividend yield, and it's definitely more than your special account. Okay, on top of that, you see the share price actually shot up at least 2 to 3 times. So you get capital gain, you get dividend you gain. Okay, and it's more. Okay, and why you are able to get that and why you have the probability of get that is because you buy them during crisis. So remember, you have to buy them during crisis. Okay, you don't buy them at any point of time that you want. Okay, so there's many examples. So for instance, let's say Vicom. I have a friend who bought Vicom during the 0809 crisis. He bought at about 170. Okay, and after that, Vicom, the dividend keep increasing. So based on the current dividend over the 170 price that he bought, right, is about 20% yield. Is it very good? I tell you, it is very good. Okay. On top of that, Vicom have grown from 170, now it's 560, So it went up like 4 times upwards. So remember, always buy good companies, stable, recurring in nature, okay, for your CPF money. Because you must know, CPF money is always your hard-earned money. Don't invest as you want to invest. Okay, and be patient to invest. Okay. Next is probably some of you say that Victor, I do not have enough time, and I really don't know what to buy. I don't have the knowledge to invest in stocks. What can I do? Okay, so the next thing you can do is you can invest in the index. Okay, so if you look at this, which is the STI index, you can see every time the index dipped more than 20%, you buy. Okay, so all this circle green color is the instance where the index dip, and that's where you can buy STI ETF, okay, which is exchange traded funds that track the index. So if you are a very lazy investor, you don't know what to do, just invest the index. Okay, it's better than doing nothing. Okay, but of course, if you invest in individual companies, your returns are make more. But if you invest in index, you still can beat your 4%. Okay, but just that you don't earn that much. That's only. So, so basically, in the Singapore, there's two index. Okay, there's two ETF. One is the Nikko AM STI ETF. Another one is the SPDR STI ETF. Okay, so there's two of them. Two of them track the index. So which one should you look at? Right, that's your next question. So now let me go to the website of these two company, and we look for what should you look at. Okay, so first you want to what you want to do, right, is you want to look at for informations like expense ratio and tracking errors. Okay, expense ratio is the cost that the index you have to pay them. Okay, the expense. So what you want to do is you want to buy into a very low cost index. Okay, because you want to keep all your costs as low because you're using your CPF money. This is the first thing. Second is tracking error. You want the person who managing the ETF, because basically ETF, right, they try to buy into companies that are in the STI and they want to mimic it, they want to copy it. Okay, so there's some error in it. You want to buy with a minimum error. That means they are very close to the index. So there's not much of error. Okay. Before I move on to the website, let me tell you one thing. Okay, a lot of people ask me, okay, Victor, do I do dollar cost averaging? Okay, I don't believe in dollar cost averaging. I always believe in buying when there's opportunity, and when the opportunity comes, you have to buy big. Okay, that is my style investing. I don't believe in dollar cost averaging. Imagine during the market very boom, you still dollar cost average. I won't do that. Okay, you're buying upwards. I don't like to do that. Okay, this is the first thing. Second thing is people ask me, the POSB or maybe DBS or OCBC, I can't remember which bank, right? They offer this blue chip STI ETF buying for you. That means they help you buy the ETF. So you every month they will deduct from you and they take your money and buy ETF. It's as good as it means dollar cost averaging. This is the first thing. Second thing is I don't believe in that. I rather you go and buy it yourself. I tell you why. Because right, you already when you buy through your broker, right, sorry, and you buy through your let's say your CPF, your broker, you already have to pay a fee. And if you want to go through the bank to do that, you still have to pay a fee. Why do you want to pay extra fee? Right? Your job is to keep your costs low and make the money out. Okay, try to be a bit more thrifty. Don't spend all your money. Okay, so now let me go to the website. Okay, so now okay, I'm going to search what's the name? Nikko. Okay, Nikko AM STI ETF. Okay, next I'm going to search the SPDR ETF STI. Okay, so this is the website. Where's the Nikko? Okay, so this is the website. Okay, so let's go through the Nikko one. Okay, so let's say I click on the, this is already the ETF. Okay, so you just click on the fact sheet. Okay, and let me click on the fact sheet for the SPDR. Okay, so let me look at the Nikko one. So if you look at the Nikko AM, right, like I said, we need to look for two things: the expense ratio and the tracking error. So if you look at their tracking error is about 0.21. So you can see here the tracking error 0.21. Okay. Next, we want to look for the expense ratio. I think they do not have it here. Let me see whether they have it under the fund detail. Okay, yeah. So here's the expense ratio, 0.35%. Okay, so remember these two numbers, 0.35% at 0.21%. Okay, and you can look at the Nikko AM, right? The return since its inception is about 11.59% CAGR growth. If I not guess wrongly, okay. If let us look at the fact sheet in the SPDR. So if you look at SPDR, it's about exclusive of dividend is 4%, but inclusive of dividend is 7.55. Okay, so remember, always reinvest your dividends, don't spend it first. Okay, but if you ask me why the SPDR is lower return as compared to the Nikko AM, you must know that both of them incept in the different year. So SPDR started in 2002 and Nikko started in 2009. Okay, so one started during crisis and one started not during the crisis. So take note about it. And the next thing I want you to take note is that it doesn't matter which tool you buy. Okay, in the end, your performance will be still the same one. So don't worry about that. Okay, but what I want to do is I want to find the lowest cost one. So let's look at the expense ratio for SPDR is about 0.3%. And let's look at their tracking error, which is 0.0896. So they got lesser error as compared to the Nikko. That means they are very close to the index, their returns. And their expense ratio is also lower than the Nikko. So now let's go back to the slides. So after I show you the both of this STI ETF, you can see that, like I said, both of that is inception on different year. So the SPDR inception in 2002, the Nikko is about 2009. So the expense ratio, which is lower for the SPDR as compared to Nikko. So like I said, you want to buy into a low cost fund. So you want to as low as possible. So you want to buy the lower expense ratio one. So you can see that SPDR got the lower expense ratio. Next is tracking error. So if you realize that Nikko got higher tracking error as compared to SPDR. So SPDR that means if you compare both of them, right, SPDR is very, very closely in line with the index. Okay, and both of them pay dividends. So for the STI ETF, right, they pay twice a year dividend. Okay, so both of them pay same thing twice a year. So if I want to invest in ETF, I think I will just put into SPDR. I want to go into the lowest cost ETF. I don't want to go to any high cost, because moreover, both of them, the performance are the same. And moreover, first, SPDR is lowest expense ratio. Second, they are very, very close to the STI as compared to Nikko STI ETF, right? So this is what the two things that I'm going to look at. Okay, so I hope I give you a very good overview of how to invest in the in the CPF money. So what I'm going to do right now is I'm going to go into the Q&A segment. So if you have any question, just type in the chat box. I will answer it live from here. And I also got some pre-submit questions here that I'm going to answer right away. So now I'm going to stop the screen sharing. Give me a minute. Okay, I'm going to stop the screen sharing. Okay, I'm going to show my face. Give me a minute. Okay, my webcam is taking some time to load. Give me a minute, huh? Okay, why is it so long for the webcam? Okay. Can you see my face? If you can see my face, please type yes in the chat box. Okay, give me a minute. Some of you can't see yet. Give me a minute. No. Webcam loading. Okay. I just wait for a while for you guys. Still loading. Okay, give me a minute. Let me check. Okay. It's okay if you can't see my face. Don't worry. Probably it takes some time to load, but you can hear my voice. Am I right? Can you hear my voice? Okay, good. So all of you can hear my voice. Doesn't matter. It doesn't need to see my face also. So now I will start answering the questions. Okay, so please type your questions in the question box. Okay, and And okay, I'm going to start off with probably okay, let me choose the question. I'll give me a minute. Give me a minute. Which question? Okay. So Jessica asks, if the CPF investment lose money, do I need to fill up the losses back into the CPF someday in the future? Okay. So for the CPF investment, right, is very, very different from the HDB. When you use your HDB to invest, right, is when you buy into your BTO, or use your CPF money to invest, right? So when your money go out to buy your HDB, right, in the future, the earnings from when you sell your flats, right, have to go back to your CPF, because you are depriving the CPF from making 2.5% every year, so you have to pay back. Okay, but if you use your CPF money and invest in stocks and you lose money, you don't need to top back up the losses. So don't worry. Okay, this is confirmed because I called the CPF and checked with them. Okay, so don't worry about that. Okay, so now I go to the next questions. Okay, some of them. Jessica also asked, would dividend received via CPF investing taxable? No, CPF. Singapore. Our laws are rather tax free. Okay, so don't worry. It's not taxable. Okay. Let's move on. Next question is, I would like to know if we must go through POEMS or a broker to buy stock using CPF. Yes, you have to go through a broker. Do we need to pay a one-time fee or maintenance fee for the unit trust bought using CPF? Like I said, you have to buy through if you buy through a broker, you have to pay the broker fee, and if you buy and also you have to pay the CPF investment account fee. Okay, and the fee for the unit trust is a bit different from the shares. So take note, whatever I share with you just now is just for shares only. Okay. So next questions is, how to invest with money in this special account? What assets that can beat the 4% interest rate from the special account? Okay. One thing I want to let you take note that your special account only can invest in unit trust, investment linked policy, endowment, Singapore bonds, annuity, and treasury bill. And all these things that your special account can invest, right, will never make more than 4% for you. Okay, so don't use your special account to invest anything. Your special account risk-free 4% is very, very good already. Don't take your money out of your special account. Okay, all the things that they offer you are unit trust and all this, like, will never make the 4%. So don't waste your time. Leave your money back in the special account. Okay. So let me answer one more question before I go to the some of the questions that you post online right now. Let me see what's a good question here. Okay, I think probably not much of a good question here. Let me see what's on the live chat now. Okay. Okay. Yingling actually asks, hi, would you suggest selling of the ETF or stocks when the market is high? Personally, if you buy, let's say, the ETF, right? Okay, I'll think it as accumulating the like accumulating stamp. So every time down, you keep buying. You want to sell, I probably won't sell everything. I will just probably sell half or still keep some of them down there. So but the important thing is you must know when is the market high and when is the market low, because sometimes the market can go high in a very long years. So for instance, there's this fund manager who sold in 1996 and he holds a lot of cash, but the stock market went up for the next 4 years until 2000, then it's crashed. So if you can hold for the 4 years when everybody is making money, then it's okay. Okay, but you do not want to. what I scared is you become itchy, you know. When you see everybody making money, you start to invest your money back, and you bought everything at the high end, you start losing money. Okay, so take note about it. Okay. Joanna asked, profit and dividend earned from the using the CPF funds, all this will go back to the CPF account, right? Yes, all will go to your CPF account. We cannot cash it out, right? You cannot cash it out. Okay, you only can cash it out when you hit the age. Okay. So let me see. Christopher asks, is there accrual interest for the money used for investment like HDB loan? Like I said, there's no accrual interest for the CPF account, so don't worry. Dividend will be deposit into your CPF investment account. Yes, after they will send back to your CPF. Marco actually asks, do you think that we need to see what company does the index hold before you invest? Because I believe not all companies that the index holds are good companies. Actually, don't worry about that, because index consists of the most, usually they only put stable companies inside the index, and the companies always change one. So don't worry about that. The most important thing is that you know that index in the long run will always go up. Okay, because of, okay, I can tell you, if you look at all the index around the world, every index go up in the long run. Okay, except for the Japan index. That's all only. Okay, so other than that, don't worry about it. So Daniel asks, how do you tell when the market is overly high or low? You look at the market P, okay, or the market PB of the index. Okay, let me look for more questions. Give me a minute. Willie says, sorry, I missed the first part on investing in the SPDR ETF index. So I want to know if we should also invest in SPDR ETF during downtime only, or we buy it anytime. Okay, like I say, I don't believe in dollar cost averaging. I don't believe in buying it at any, like every month you save and you buy. You know, only buy it during downtime. Okay. Sim Kim actually asked, is it better to use all our CPF money to pay off the BTO, HDB, or to take out to invest? Okay. I would say this is a case by case basis. Okay. Let's say if you have the money to pay down everything. Okay. Probably for me personally, I probably won't pay down everything yet. Probably I will maybe set maybe a 5 or 10 years goal first to pay it down. But in the meantime, I wait for opportunity to come. Okay. But if you are those who can't save money and got money financial, I think got financial management issue, then I'd rather you pay down your HDB. Okay. It's case by case basis. Okay. But personally, for me, I do not have any financial management issue. So I don't bother to, you know, to pay down everything immediately, because I know that in future, I probably will get a higher return. If the crisis comes, I can buy it. Okay. So let me move on to other questions. Okay, give me a minute. Whoops. The question is coming very fast. Okay. Okay, I can tell you what. You just keep typing the questions, okay? Because the question is moving very fast. So the old question I can't see because a lot of people is typing. What do you see in the near future? Joseph actually asked, what do you see in the near future for Singapore stock, uptrend or downtrend? I don't know. I do not have a crystal ball. Okay. But for me is I just focus on fundamental strong company. That's all. Okay. Jacob asked, is if the criteria for using CPF are met, how will you decide to use cash or CPF? What do you mean? If you met your criteria, you can use your CPF. I'll treat it as CPF as a separate money, not with my own cash money. So don't worry. Because after all, it's locked down there. As well, you want to, while locking, you want to build it better. Okay. Okay. Raman asked, actually, is there any maintenance fee that the custodian bank charge aside from buy and sell using the CPF? Yes, there has a service charge. Every quarterly, they will charge you $2 per counter. Okay. Let me see. Okay, so you have to slow down your question because the question is moving very fast. Give me a minute. Can the supermarket stock be considered a recurring business? Jeremy asked. Yes, it is considered recurring business, but you must know they may be facing disruption, especially when Amazon Prime is coming in. So just take note about it. Okay, there may be a structural change in that. John actually asked, is it better to use your cash to pay for your home loan rather than your CPF money? I think it's case by case basis. I mean, if you know how to manage your money well, if you know that there's chances that there's opportunity for you. Probably I think you should keep your cash to buy during the downtime, right? Christopher asks, is telco stock still a good dividend stock? Telco is facing disruption right now, especially when the fourth telco is haven't even coming in next year. So there's more hurt coming to them moving forward. Okay. Let me move on. Okay. Okay, wait. Give me a minute. Inling actually asked, wondering if you know what happened when we reach 55. Do we have to cash out all the investment? I don't think I haven't reached that age yet. So I'm still very young, so I do not know whether you have to cash out. But I know that not all your CPF money can be taken out. So myself, you put down there. Okay, you take out what you can take out. That's all. Let me see. What's the name? Sally actually asked how to prevent our CPF from wiping out our OA if we take HDB loan. Okay, they only wipe out your OA account when the day when you're going to take your key. Okay, what I hear from most of my friends do is before they know they're going to take the key, let's say on this date, before that they already start maybe take the money and buy into probably a more stable company that you know the share price won't fluctuate up and down a lot on. Okay, so once the CPF wipe out your account, right, then you sell your shares and put it back. Okay, you may have some transaction costs on that. Okay, but it can be very risky, so take note about it. Natarajan asks $2 custodian charges to broker or CPF. $2 charges, right, is is the bank charges you for every counter you own. Okay. Let me see. Jeremy asks, can car tire stocks be considered recurring business? Totally no. Okay, I have experience in that. It's totally not recurring in nature. Okay, they can go through an oversupply issue. Cecilia said at age 55, you can withdraw all in excess of your minimum sum for your info. Okay, good. Marco shared, can you share a bit on why Japan index has not been growing? Because Japan index have been through a year of deflation, okay? And they are facing aging population. Despite their index not growing, right? But individual stocks are growing. So don't worry about that because the index are all the large companies and you know Japan is very close on. Okay. Natarajan asks, is it possible to invest in gold through SPDR? No, I mean you can use your CPF to invest in gold, but I don't encourage that. Okay, I personally don't do that. Okay. Is the Singapore Inc actually asks, is the Singapore ETF considered very expensive right now? The market is at fair value right now. It's not really cheap and it's also not really expensive. Okay, especially the whole world is not really cheap or not expensive. The US is expensive. Okay, I think Malaysia is also rather above fair value. I have to go check again. I can't remember. Okay. Sally asks, any replay tomorrow for this webinar? Yes, there will be a replay, so don't worry about that. David Lim asked, Stanford Tire hit low of 26 cents early this year and rebound to 33 cents. Okay. But I don't look at Stanford Tire. It's rather cyclical in nature. Hello, Victor. Jessica asks, hello, Victor. Could you share some example of recurring business industry similar to defensive industry? Yes, it's rather similar. So actually, telcos used to be very defensive and very recurring, but they are facing disruption right now. So I probably won't go into the telco industries. Okay, like I say, sets are those type of recurring thing. Simon asks, buy stocks using CPF money will keep in the CDP account or under the custodian by the bank. If kept by the bank, do the bank charges custodian fee? I can't remember that, but I know that the banks have a service charge on that. Like I said, $2 every quarterly for every counter you have. Custodian, I think they'll be under CDP if I guess wrongly. Okay. So yeah. So I think I will probably answer another 1 or 2 questions before I'll stop the webinar. It's going to be an hour soon. Let me see some past questions, whether is there a good one, right? To talk about. Ying actually asked, do you run any program teaching people how to invest? Yes, we run. We have investment quadrant, dividend machines, and also deep value investing. Okay, so if you want to know more about it, just be in our email list under fifthperson.com. Okay, let me look for other question. Okay, what are the questions that we have? Okay, Chris say bank is the custodian for the CPF share. Okay, thank you, Chris. So Chris say that bank is the custodian for the CPF. So your CPF, you buy your stocks, they don't go CDP, they goes to the bank. If you use CPF to buy, can attend AGM? Can, but it's very troublesome. You have to go through a lot of process just to get to attend, and you may or may not may or may not even able to attend, because everybody also want to go there. You must know you are not the only person under the CPF to buy into that company. So just think about it. Okay. Oh yeah, next thing is someone asked actually, should I invest using my SRS account? Okay. You must know SRS account, right? When you want to put your money down, it is for tax purposes, because you want to get lower tax. But if your SRS account, you invest until you got cross 400,000, right? Then after 400,000, you start to have tax already. So think note about that. Okay. Just invest using your OA account. That is, I think, more than enough for you already. Okay. So just take note of that. That use everything, invest through your OA account. Okay, so I think I answered all the questions so far. So thank you so much, and I will see you in the next webinar. Okay, I hope you learned something today, and I'll see you probably next month for the next our next webinar. Okay, thank you so much.